In terms of the entire bear market, it would be unusual for it to bottom out anywhere near this high. I would expect that by the low, that the S&P would have declined by 50% from the peak in real terms. So a year from now, when the bear market might end, the trend line value would be almost 3,000 on the S&P. Of course, there's no rule that says you stop at fair value. Typically, in previous big bubbles breaking, they go down below that. That's a lot of pain, and it's possible that would do that again. But you do have to adjust for inflation. There was very little inflation around in 2000. But this time, with inflation running at 8 or 9, it does move the nominal value of the S&P upwards, and one shouldn't lose sight of that. It's hard in a bull market to get your brain around what happens in a bear market. Let me go back to Amazon. Amazon in the 2000 bust didn't just come down. As its sales continued to grow, of course, in those days, it didn't have earnings because it was running on borrowed resources. It came down 92%, 92%, with strongly rising sales. A brilliant, successful new idea that went on to own the world and be worth a fortune. How is it possible it came down 90%, 92%? So think about that sometimes as you go to bed. I like to say 80% of the time the market is pretty sensible and doing a possibly good job of estimating value for all the companies. A little under 15% of the time, it gets carried away with optimism. And by the end of that time, has nothing to do with actual earnings. It's all in the head, projecting out hundreds of years into the future, assuming that perfect conditions will stay perfect forever. Every bubble takes place with near perfect conditions and huge profit margins. And the market runs with that and assumes it will stay there forever. And of course, conditions mean revert, profit margins mean revert, and good times become bad times. And that is a problem. No, I expect the Fed to be behind the curve, to be deep into optimism, and it doesn't really have a clue about market bubbles and the damage they do when they break. They've been eager now since early Greenspan to encourage bull markets because they help the economy, they really do. And they always forget that the bear markets to go along with them hurt the economy at just the wrong time. So if I'd been asked to bet, would the Fed get inflation wrong when inflation came along at any time, I would have said, of course, they'll miss it, they'll be late, their responses will be pretty ill-judged. The Fed's record is terrible. What is impressive is how much room they have been cut by the market. I mean, the market is incredibly forgiving to the Fed. This Fed had a wonderful environment. They did nothing right, but they were seen to be presiding over low inflation and decent growth. The growth rate actually has slowed way down since Greenspan. It was averaging 3.5 before Greenspan and averaging 2.5 afterwards, and today more like 1.5. It's done nothing in terms of increasing the growth rate, but superficially, it felt like a golden age because asset prices went up. Asset prices went up because inflation came down and rates were allowed to come down. And in the end, rates were forced down. And low rates make leverage cheap, make private equity deals wonderfully easy and profitable, and they push up the price of real estate and they push up the price of stocks. And that's the way it was. And the Fed gets credit for that and it's due none. Its demerit accrues from the fact that it kept on pushing down interest rates far too long and dangerously, increasing inequality, which, as I like to say, is the greatest poison in the system these days. And it does damage the degree of inequality we have in the US now, does damage the strength of the economy. And it is probably part of the reason why the growth rate has slowed and continues to slow.
There's a lot of concern that we're entering into a 1970s or 80s scenario of stagflation. As a historian, could you give our audience an idea of what was happening during that period and how it resembles today?
Well, every period is unique. The 70s had problems with the oil crises. You can call it one giant crisis, or you can call it two or three. But in any case, it tripled, quadrupled, quintupled the price of oil in a hurry. We'd come off 50 years of fairly stable, low prices, and they shot up and stayed up for a long time and inflicted enormous pain on the system. They lowered the growth rate. Why wouldn't it? If you have to pay 3-4 times for your energy, it also, of course, pushes up the price. So there's nothing like an oil price increase to increase stagflation, and it did. And this time, if you adjust for the passage of time, the price of oil is not as high, but it's still multiplied recently by 3 times. So that is imposing pain on consumption, and it's imposing inflationary pressure. We also have, because of the invasion of Ukraine, we have had some extra spikes in the price of food, fertilizer, and natural gas, particularly in Europe. Interestingly, they are now, almost all of them, lower in price than the day before the invasion. And this is a lovely example of how the stock market works. The stock market is saying, whoops, there's so much damage from commodity price rises, et cetera, that we're going to have a recession. But the recession isn't bad news, because the recession is going to get the Fed back in our camp of lowering interest rates again and helping stock prices. And we're looking out into the future, and therefore that's a good news. So the fear of a recession becomes a wishful thinking about future interest rates. And so the market gets a reprieve for a while. It's quite remarkable, but it's fairly typical. And that's what we're having now. And that's why we might have a bit of a rally for a few weeks, I think. I think in the longer term, forget the next few quarters, who knows what happens really. But in the longer term, we are really running the risk that this is back to the 70s. We have problems with the availability of plentiful, cheap resources. We have problems with plentiful, cheap labor. The birth rate has crunched in every developed country except Israel and China. That's a very, very important segment of the global economy, to say the least. And every one of them has a population growth rate lower than replacement level. So in the end, after accumulating lots of older people as a higher and higher percentage, we start to actually have the population drop. Secondly, we're 10 and 20 years in, depending on the country, into having smaller baby cohorts. So we know with absolute certainty, since they're alive already, that 20-year-olds arriving in the marketplace will be fewer and fewer for the next 20 years. And we have not experienced this before. This has happened incredibly fast. China has gone from plenty of babies to a baby crunch almost overnight. And their fertility rate that needs to be 2.1 is probably running about 1.4. And even in the US, the UK, we're running about 1.7. We've never seen levels like this. So we're going to have a hard time getting enough labor. We're going to accumulate old people who are very resource intensive. They need a lot of medical care. They need a lot of people care. And we're not going to have all that many people there. The supply of people to look after us old fogies is dropping steadily from now on for the rest of your life, for sure. And at the same time, I believe the correct interpretation of the commodity data is that it wasn't only the China shock, the rapid growth rate for 30 years in China, but it was also showing signs that the best and cheapest, most plentiful resources had simply been mined or pumped, and that we are running down into the second tier. If you look at the copper ore, for example, King copper is really important to the industrial system. Over 80, 90 years, the amount of copper in a ton of ore has dropped to a third of what it was. So you're using an awful lot more energy. And the energy also, which used to run for 100 years at $20 a barrel in today's currency, now runs at 100. So you're spending 5 times the cost of energy to mine 1/3 the quality of copper ore. You better believe technology can't keep up with that. It did for a long time. It did very, very well. But starting about 2002, the real price of the typical commodity has gone up a lot. It's basically tripled. In 100 years, it went from starting at 100, it went down to 30. A brilliant help for getting rich. And then from 2002 until today, it's gone from 30 to 90. So over 122 years, commodities are just about flat, adjusted for inflation. And only 20 years ago, they were down at 30 cents on the dollar. This is a huge shift. Hasn't been nearly enough fuss made about it, but it's the direction that is interesting to me. The direction is steadily up. Now there's a lot of volatility in commodities, everybody knows. You produce an extra ton and the price collapses, and you're short a ton and the price triples. But if you look at the trend has been pretty remorselessly up since 2002. And my guess is it will continue to rise. And that will pose a real stagflationary pressure for a couple of decades. And that's why I fear this is re-entering the 70s and 80s, if you prefer it, re-entering the 20th century once again. So inflation will always be part of the discussion. Sometimes it will be low, sometimes it will be higher, but it will always be on the agenda. The same with stagflation. There will be pressure on growth that we have not had. We have had a glorious honeymoon period for 20 years where rates always came down and where Chinese workers were always available, and inflation was a thing of the past, and it is no longer a thing of the past. And unless we have some sensible behavior from governments around the world, this inflation will go in little waves and will become moderately embedded at best, and really embedded at worst.